we just had the first rate cut in the US for 2025. Now, this has been something that's been long awaited, has been on the thoughts and minds of many investors and traders for most of the year, especially after at the end of 2024, it seems like rate cuts were only going to come more and more frequently. Now, that tone had changed as we saw inflation rile up and the tariff war really start to boil over. But that all leads us to where we are today. We have seen that 0.25 rate cut, and it looks like there may be more on the horizon. Again, we're speaking about the US specifically here. And really, if we're talking about interest rates and cash, and you're wondering, why does this all matter? Essentially, interest rates do help set the price of money. They alone don't move markets, but it does have a knock-on effect throughout economies. It really is what can help set off growth cycles, keep us going through cycles of sustained growth across economies. And even when you look back to years like 2022, where we did see a bear market in crypto specifically, but broadly, we saw markets really take a bit of heat. That was during a hiking cycle where we saw those interest rates start to increase and increase month on month or quarter on quarter as we saw inflation start to rise. And as we covered in previous squawks, if you have been following us, we have seen inflation cool, which has probably laid the groundwork for rate cuts. And we'll touch on in a second as what else has changed. Now, obviously, Bitcoin, we have seen its price move quite a bit higher this week again, edging it closer a little bit towards those all-time highs. But a real question now is, if we have seen that good news that everyone's been expecting, what's next? Was this already priced in? The market got what it's expected. We'll touch on that as well towards the end. But firstly, let's dive into what we know. As we mentioned, we did have that rate cut meeting at the back end of this week. And I think I just want to take everyone through a little bit of what was said, as well as what's changed. Now, that's the key thing with these events. While we do see just a data point change in terms of what's the monetary policy rate, which again, we saw a 0.25% cut in the US, we also get to hear what is a forward guidance. So basically, what is the current expectations by the committee that sets this rate heading forward? Now, obviously, there's a lot that gets put into just what they say in their speech, the tone, how they feel about the market. And then what does the data say? What are the data points that they're looking at? What benchmarks need to be attained or managed, or for them to continue along this path when we're now going to see additional rate cuts into next year? Now, the first thing I want to start on is what they said. Jerome Powell, who is the Fed chair of the FOMC, the Federal Open Markets Committee, again, he collates the representative take of all committee members, portrays that back to the media. So again, he emphasized this year that the job market was looking quite good. This meeting was the first time really he acknowledged that really jobs don't look that great. And that's been a key driver for decision-making within the FOMC committee. They basically have two mandates. Number one, ensure employment and growth remains on track and steady and to the upside. And then the second one is not to let inflation get out of control. So obviously, if we're seeing that their mandate is now seeing that inflation is coming in line with expectations, yes, it's not exactly where they want it to be, but they're at risk of potentially overcorrecting with policy and risking the job market falling apart. So that's basically what he said in this one. I'll read a line and what he said to a journalist during the event. Labor demand has softened and recent pace of job creation appears to be running below the break-even rate needed to hold unemployment rate constant. I can no longer say that the labor market is very solid. So again, when we're talking about tone, what sort of changed in their message to the public, that's the first time there's actually been an admission that things aren't as good as what they're expecting. And we have seen that through labor number revisions over the last couple of months. It always seems to be cracking a little bit further. Now, let's move away from what was said and let's move towards what has changed in terms of their expectations. Now, this is the actual summary document, which you can find a link in the Squawk today. That's a 17-page document, very heavy with jargon, but I'm going to break down what you really need to take away from this. Essentially, given what was said in that speech, this is the current economic projections that the committee expect to see into the end of 2026 and as far as heading into 2028 in the long run. But we're just going to focus on this year and next year. So if we're talking about growth, the current expectations when we compare it to June is an increase. The committee expects there to be a 0.2% increase of that particular figure. So GDP being gross domestic product. The unemployment rate, they expect to stay steady. So 4.5% there. And inflation, which is these two metrics here, they're expecting inflation to remain steady. Now, with all these benchmarks set for now, their current expectations, if we zoom ahead into this document, like I mentioned, there's a lot of jargon. we can start to understand if all these metrics are starting to land in line with their expectations, what does that mean for interest rates moving into the back end of this year and next year? And that's what this plot here basically looks to describe. It does look a little bit busy, but essentially all we're looking for are clusters. They're almost, if everyone gets to vote, we're expecting that final rate for 2025 in the December meeting to land. And we can see here that there is a growing consensus between 4.25, and a more majority consensus at 3.5 to 3.75%. So it just goes to show that there's still an expectation that there's more cuts to come in this year. We only have 2 more meetings left for this year in the US, so there is even the possibility that we do continue to see 0.25 cuts across all of these meetings, should everything continue to go in the direction that they're expecting, which I outlined just above here. So that's what's changed: an increased expectation for growth, inflation, and unemployment to remain steady. Now, you could argue that if we did see unemployment spiral faster than expected, we could see other measures come into play, maybe even outside of interest rates to ease conditions. Just because we are seeing still restrictive monetary policy in general, we still haven't really tilted towards easing completely. Interest rates is just one of the pieces of the puzzle. And again, obviously that inflation figure will be another one to watch as well, as that might also change their stance. But as we heard in Jackson Hole at the end of August, the symposium there that Jerome Powell, the chair, spoke at, he did say jobs being more of a concern. So I think that's going to be key in our understanding of what the market does heading into the end of this year. Now, this is all well and good. Like I mentioned, this was a 0.25% cut, which is exactly what the market expected. So now if we turn to Bitcoin, altcoins, right now it's just about understanding, now that the market's got what it expected, there's a good chance it might have been pricing in this cut since that Jackson Hole speech at the end of August. So really a question for us here today, especially heading into next week, are we going to see prices just hold steady, or are we going to potentially see the market become more confident and move higher? Or are we going to see the potential bearish scenario here, which could be that market participants that maybe had looked for upside at the end of August, maybe looking to take profits now? We could see just a little bit of a swing back. No one ever has a crystal ball on this at all. But obviously longer term, this is a great news story for the markets in general. But yeah, short term, we wait to see what it means. That's it from me here today. Catch you next week.